Hi, I'm Sharon Winsmith, a tax attorney, active investor, and your go-to resource for proven investment and tax planning strategies. In this video, I'm going to talk about why I think mutual funds are one of the worst types of investments you can make. I think the vast majority of people out there already understand that there's a lot of issues with mutual funds and know to stay away from them, but I want to make sure that you all are aware that mutual funds are a complete disaster. I personally think that it's crazy that you have to be an accredited investor before you can invest in things like real estate funds, but yet a financial advisor can tell you to put all your money in a mutual fund. I personally call mutual funds financial advisors on steroids. In this video, I'm going to walk you through quickly the big issues with mutual funds and why smart investors always want to stay away from these types of investments. So to start with, I just want to explain what a mutual fund is for anyone who doesn't understand. Basically, it is a fund that pulls money from different investors and invests in securities. It can invest in stocks, bonds, even other things like REITs, munis, commodities. It really, across the board, if there's this type of security out there, there's probably a mutual fund that invests in it. It was really created years ago to allow people to invest in the market and kind of get some diversification by investing in different types of stocks or different types of investments. And it is really just a way that you can go in and buy a mutual fund. You go in the same way that you would buy a share of stock through your online brokerage account, and you invest in these mutual funds. They all have their own tickers. So how do you know if you're invested in a mutual fund or if you own a mutual fund? It always or almost always has 5 letters. So this is an example of a mutual fund ticker. Typically, stock tickers are going to be 3, in some cases 4. So for example, I invest in the Vanguard S&P 500 index fund. The ticker is VOO, so that is not a mutual fund. But if it were a mutual fund, it would probably be 5 letters, and it almost always has an X at the end. So check your stock portfolios. If you've got these in there, you want to think about how you can get out of them as soon as possible. I personally think that it's a really big mistake to invest in mutual funds. And if you have a financial advisor and you've got, he or she's got you invested in mutual funds, I would fire them today. I would fire them today anyway, but I would fire them because this is, in my opinion, it's just crazy that you would pay someone fees to manage your investments and then pay the ridiculous fees that mutual funds charge. So if you've got these in your portfolio, you need to take a serious look at this and see, does it really make sense for you to stay in those? Just quickly, the issues with mutual funds, there's a ton of issues. I'm just going to run through the main ones. Again, this is not something new. This is not something that's hidden. I think the vast majority of people understand this, but I still see situations where, I'll talk to my friends or people that have a good bit of money and I think a good level of sophistication, but are still owning mutual funds because they didn't know how bad they are. So quickly, they have high fees. They have high expense ratios. Before you buy any stock or anything, you should check the expense ratio. You always want to keep that low. That's why I talk about when I say I like low cost index funds, they have low expense ratios. Mutual funds, especially active mutual funds, are almost always going to be higher. You also have other fees, and in some cases, you don't even know you're paying those fees because it's not super transparent. But there's things like sales charges or load fees. Those are basically just fees that apply or when you buy or sell the shares in the mutual fund. They're also very tax inefficient. This is probably one of the biggest reasons most people stay away from them. They make frequent trades all the time. So those frequent trades give rise to short-term capital gains that are taxed at ordinary income rates, which is bad. We never want to pay short-term capital gains tax ever, 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 because you've already taken high taxed income, whether it was from business income, salary income, whatever. The last thing you want to do is put that in investment. It's going to kick off something that's going to make you pay ordinary income tax rates. So short-term capital gains are terrible. They also have phantom capital gain income. So all the requirements for mutual funds and the way that they're required to operate, some cases you can have taxable income that you have to pick up on your tax return from that mutual fund, even if there was a net loss for the year in some cases. Also, sometimes you can have a higher tax bill just because of when you came into the fund. So we know we never want to buy into mutual funds. Well, we never want to buy into them, period. But if you are going to buy into them and not listen to me, don't buy into them at close to the end of the year because they have to make distributions every year and you may be buying into a tax liability without getting that allocation or that money. As I mentioned, the frequent trades are also bad. That's probably the worst part, but depending on when you buy into that mutual fund, you could have a tax liability that doesn't even relate to earnings or money that you're going to get. They have a lack of liquidity. So the way they work is they only get priced one time a day, and that's after the markets close. So you can't really control the price at which you're buying the shares. If I want to go buy more of my VOO, I see the price right now, I buy it. That transaction goes through within seconds. Usually before I refresh the page, the transaction's gone through. You can't do that with mutual funds. You put in your order, it goes in through, the end of the day. A lot of cases, you don't know what the pricing is on that, what you're paying for it. You don't get to take advantage of intraday price changes. Also, you can't redeem immediately. So if I wanted, I think this is crazy, but let's say something happens and I need to liquidate all my shares of stock. I can go sell my VOO. That transaction's going to go through immediately. I know what price I'm selling it at. It's going to go through, and that's clear. But the mutual fund, it's not going to close till the end of the day. So not as much liquidity, and that can be a bad thing, especially when you think about something like stock market investing, where a big pro of that is the liquidity that it provides. So the biggest thing, one other thing with liquidity is that with the requirements that mutual fund managers are required to, there's a lot of requirements that they have to, comply with. There can be a big cash drag. So because the transactions don't clear to the end of the day, they have to maintain a lot of extra cash on hand that wouldn't normally exist with something like an index fund. Cash is bad in this case because there's a cash drag. Every time they're holding cash, you're not getting any returns on that. So that's what we call cash drag. When you hold cash, you're not getting investment returns. So there's a big opportunity cost you're losing, and that is cash drag. So mutual funds do have some cash drag that isn't in existence for other investments that you may make. They typically almost never beat the market. This is the thing that just makes absolutely no sense to me, why you would invest in a mutual fund as opposed to a S&P 500 index fund that is the market. Why you would pay more fees, get more tax inefficiency, have less liquidity to invest in something that's going to make you less money. So studies showed that on a long-term basis, that mutual funds over 90% underperform the market over a 10-year period. So this is crazy to me. To me, that should be enough. I don't understand, why people still invest in these. I think the people that do invest in them just kind of have the hands-off approach where they just trust the financial advisor. They just didn't really spend a lot of time on it, which is fine. Now and now you can, readjust and make different decisions going forward. But they almost never beat the market. You're still with a mutual fund, you're still relying on the expertise of one person. The very few that have done well on a long-term basis, which is, again, probably a number you could count on your hands, but they're always relying on the expertise of one person. And I hate to be, grim, but that person's going to die. So it doesn't matter who they are. If Warren Buffett was managing a mutual fund, which he wouldn't because he doesn't like them, but if he were managing a mutual fund, he is going to unfortunately die one day. And then you lose that expertise. You lose that, future performance that he was getting or she was getting, whoever's the big person. So you're always with the mutual fund relying on the expertise of one person or a group of people. And that is not, you can't bet on someone long-term like that because you don't know what's going to happen to them. And, we all die, unfortunately. That's just a sad fact, a sad reality. So how can you invest in something long-term when you're investing in the expertise of one person? So what I do instead of mutual funds is I invest in low-cost index funds. So these are passive ETFs. I'm not going to dive into what exchange-traded funds are, but these are, ETFs. They're passively managed. They're not going to have high fees because they're low cost. We look at that expense ratio. They're not going to have those sales charges and those load fees. They're tax efficient because they don't trade frequently. They're passively managed. I, have tons of liquidity. I can go in and sell my shares and it'll, the transaction will go through in seconds. And they are the market, right? So when I invest in a low-cost index fund that's an S&P 500, I'm getting the S&P 500 return. So that's market. So again, this is just a quick primer on why mutual funds were bad. If you are someone who owns mutual funds, need to take a look at this, need to understand why we don't prefer those and why smart investors don't invest in these when they almost always underperform the market and have a lot of other really bad characteristics. So hopefully you found this video helpful. If you did, please like the video and subscribe to the channel.